Imagine for a second, right, that I slide two different investment portfolios across the table to you.
Okay, I'm picturing it.
So portfolio A holds, nearly 200 different companies. It spans a bunch of multiple sectors and has this tiny expense ratio. And its marketing materials proudly declare it a, quote, broadly diversified large cap growth fund.
Right. And Portfolio B.
Well, Portfolio B is just 10 companies. That's it. Just the massive tech giants you hear about on the news every single day.
Yeah. And instinctively, almost everyone reaches for Portfolio A.
Exactly.
Because we are taught from day one of our investing lives that, diversification is the ultimate safety net.
You don't put all your eggs in one basket.
Right. You buy the 200 stock basket. That just feels safer.
Right. But what if I told you that in the year 2026, Portfolio A is essentially just Portfolio B wearing a very convincing trench coat?
Huh. Trench coat, yeah.
Like, what if you're looking at your portfolio right now thinking you're safely diversified, but underneath it all, you are just buying the exact same 5 tech giants over and over and over again, just under different ticker symbols?
It is one of the most profound illusions in modern finance. It really is.
It's crazy.
You read the fact sheet, you see a list of hundreds of constituents, and it provides this immense psychological comfort.
Oh, totally.
But when you strip away the marketing and you ignore the fund's name, and look at the underlying math of how these indexes are actually weighted.
The actual mechanics.
Exactly. The diversification you think you are paying for often does completely evaporate in practice.
And that is exactly our mission for this deep dive today. We are taking you on a really comprehensive journey into the actual engines that drive your portfolio.
We really need to pull these things apart.
Yeah, we're pulling apart the absolute heavyweights of the ETF world. So we're talking SPY, SCHG, VUG, QQQM, and we're comparing them to a really fascinating structural alternative known as GURP.
Which is a whole other beast.
It really is. We are going to unpack the history of how the ETF revolution started, expose the hidden single stock risks that are currently lurking in the most popular growth funds, and most importantly, we are going to figure out which fund structure is mathematically best prepared to protect and grow your wealth.
Especially in a future where valuations are, frankly, incredibly stretched.
Right.
Because we are operating in a very specific and quite fragile landscape right now in 2026.
Yeah, the market is weird right now.
It is. Traditional narratives, especially around artificial intelligence and mega-cap tech, they're being heavily tested by the macroeconomic environment.
For sure.
So the goal of this deep dive isn't to declare a single winner or, to give you some magical stock pick.
No, we don't do that here.
Right. The objective is purely mechanical. We want to decode the internal wiring of these funds so that you can align your money with your actual risk tolerance rather than relying on the perceived safety of a fund's label.
And to do that, we are leaning on an incredible stack of research today.
We really have a lot to get through.
We do. We've got the latest 2026 market forecasts from Morningstar. We've got decades of historical performance data from Total Real Returns, and some incredibly granular structural analyses from Dividend Vision and RavenQuant.
It's a really heavy data there.
Yeah. Plus, we're folding in broader thematic market insights to just contextualize where the global economy sits right this minute.
And when you synthesize all those sources, a very stark reality emerges.
Which is?
The legal and mechanical structure of the fund you choose is frequently just as important as the individual companies held inside it.
Okay, let's unpack this, because to really grasp the mechanics of what's happening to your money in 2026, we have to rewind the clock a bit.
We do.
We need to look at how this entire ETF revolution was born, and crucially, how some of the earliest pioneers created legacy structures that eventually required massive fixes.
Yeah, the early stuff wasn't perfect.
Right. So take us back to 1993. Take us to the birth of SPY.
Man, 1993. It is genuinely difficult to overstate how revolutionary SPY was. That's the SPDR S&P 500 ETF Trust, when State Street launched it in January of that year.
Because before SPY existed, what were you even doing?
If you, the everyday retail investor, wanted exposure to the 500 largest companies in America, your options were severely limited. You had to buy a traditional mutual fund.
And traditional mutual funds were notoriously clunky.
Oh, incredibly clunky.
Yeah.
They often came with high management fees, for one.
Right.
But more importantly, they only priced once a day.
Wait, explain why that's a big deal.
Well, if the market crashed at 10 a.m., and you wanted to sell your mutual fund to protect your capital, you
It's
couldn't.
just stuck.
You're stuck. You had to submit your sell order and basically cross your fingers, hoping the price wouldn't fall further by the time the fund's net asset value was calculated after the market closed at 4 p.m.
That sounds terrifying in a crash.
It was. Plus, they were highly tax inefficient.
Why is that?
Because when the fund manager sold stocks to meet redemptions, like if other people wanted their money out, it triggered capital gains taxes for everyone holding the fund.
Even if you personally didn't sell anything.
Even if you didn't touch your account, you just get a tax bill.
Wow. So SPY comes along and flips the table on all of that.
Totally flips it.
Suddenly, you can buy the S&P 500 in a single click, trading it intraday, minute by minute, exactly like you would trade a share of Coca-Cola or Ford.
It completely changed the paradigm of investing. It introduced this thing called the creation-redemption mechanism, which kept the ETF's price intimately tied to the value of its underlying assets.
And that fixed the tax thing.
Yeah, it largely shielded investors from those nasty mutual fund tax surprises. And because of that first-mover advantage, SPY's scale today is practically unfathomable.
It's a behemoth. I mean, looking at the data, we are talking about massive institutional-grade liquidity.
Huge.
It holds over $400 billion in assets under management. It trades roughly 57 million shares every single day.
That is extreme liquidity.
Yeah, and it paired that liquidity with what was, at the time, a remarkably low expense ratio of 0.0945% annually.
Right. Less than 0.1%.
And that low cost is a massive part of why it has been such a legendary wealth-building tool. Like if we look at its 10-year rolling return leading up to our current data set, it's up roughly 318%.
Which is incredible.
It compounded at 15.38% per year. I mean, when you aren't bleeding out 1% or 2% a year to an active mutual fund manager, the mathematical magic of compound interest is just staggering.
It really is.
But, and this is a critical turning point in the conversation, just because STY is the most famous, just because it's the pioneer, does not automatically mean it is the best choice for how you are investing today.
Well, absolutely not.
In fact, State Street, the exact same provider that manages SPY, quietly offers a hidden alternative that is objectively better for a massive chunk of investors.
Right.
So,
We really have to shine a light on SPYM here.
yeah, SPY.
It was formerly known under the ticker SPLG, but recently rebranded. It is also a State Street S&P 500 ETF.
So it's the same thing.
It tracks the exact same index. It holds the exact same 500 companies. The top 10 holdings are identical in the exact same weights. But the internal cost structure is radically different. SPYM has an expense ratio of just 0.02%.
Wow. Compare that to SPY's 0.0945%.
Right.
So hold on. If I'm an investor looking at this, it sounds like an absolute no-brainer.
It does.
Why on earth would anyone buy SPY if SPYM is almost 5 times cheaper and tracks the identical index? Is State Street just like intentionally cannibalizing its own flagship product?
It isn't cannibalization, actually. It's market segmentation.
Okay, what does that mean?
It comes down to understanding the hidden costs of trading, specifically liquidity costs versus holding costs. And which one matters more to you depends entirely on your time horizon and your trading frequency.
Break that down for us. What do you mean by liquidity costs?
Okay, think about the bid-ask spread. When you buy a stock or an ETF, there is the price someone is willing to pay the bid and the price someone is willing to sell it for the ask.
Right.
The difference between them is the spread, and it is essentially a hidden transaction fee that goes to the market makers.
Okay, makes sense.
Now, SPY is designed for active day traders, massive institutional investors, hedge funds, and people using complex option strategies.
The big guys.
Yeah. And because SPY trades 57 million shares a day, its 30-day median bid-ask spread is essentially 0.00%.
It's just zero.
Practically zero.
Oh.
There is so much supply and so much demand that you can jump in and out of $20 million worth of SPY instantly without moving the price at all.
But SPYM doesn't have that volume. It's the younger sibling.
Exactly. Because SPYM has a much lower daily trading volume, its bid-ask spread hovers around 0.01% or sometimes a little higher.
Which sounds tiny.
It is, unless you were a high-frequency trader or a hedge fund algorithm jumping in and out of the market 4 times a day.
Oh, right.
Then that 0.01% spread on SPYM will actually bleed you dry over time. The transaction friction will cost you far more than whatever you save on the lower 0.02% expense ratio.
So they stick to SPY.
Right. The Bloomberg Finance data on this is definitive. High-frequency trading in SPYM leads to higher overall costs than trading SPY. State Street keeps SPY at a slightly higher fee, because the institutions are willing to pay it for that ultimate liquidity.
But what if you aren't a hedge fund algorithm? Like, what if you are the person listening to this deep dive right now and you just want to buy the market and hold it for 20 years?
Then SPYM is strictly mathematically superior for you.
Period.
Period. If your priority is long-term holding, let's say you are dollar cost averaging $500 into an IRA every month, you do not care about losing a fraction of a single penny on a bid-ask spread once a month.
Yeah, of course not.
You care about the total cumulative cost of owning the fund over a decade. Over a 10-year horizon, letting your money compound at a 0.02% fee versus a 0.09% fee will save you a highly substantial amount of money.
And there's also a massive accessibility difference in the share price itself.
Oh yeah, the nominal share price.
Because SPY is trading well over $600 a share right now,
Wow.
while SPYM is sitting under $100.
Which is a big deal for retail investors.
Exactly. If your brokerage account doesn't allow you to buy fractional shares, which is still surprisingly common, and you only have $200 to invest this week, you physically cannot buy a share of SPY.
You are literally priced out of the Pioneer.
But you can buy 2 full shares of SPYM and instantly have the exact same S&P 500 exposure.
Exactly. It's about aligning the fund's mechanics with your operational reality. You don't need a sledgehammer to drive a thumbtack, you know?
I love that analogy.
Thanks. And this exact same dynamic, this tension between a legacy structure meant for traders and a modern structure built for long-term investors, it exists in an even more dramatic way with another massive fund.
Oh, I know where you're going. QQQ.
QQQ.
The legendary NASDAQ 100 giant. I mean, it launched in 1999, right in the thick of the dot-com boom. And it has heavily marketed itself as outperforming the S&P 500 by over 500% since its inception.
The marketing is very strong.
Very strong. But when you dig into the legal structure of QQQ, honestly, it is like buying a high-performance million-dollar sports car, but discovering the handbrake is permanently welded into the up position.
That is a brutally accurate analogy. Most investors do not realize that QQQ is not a modern ETF.
Wait, it's not?
No. It is legally structured as a unit investment trust, or UIT.
The UIT, okay.
This is a structural relic from 1999 legislation. And because of this archaic legal framework, QQQ suffers from 2 severe structural handicaps. First, a UIT cannot lend out its underlying securities to short sellers.
And why does that matter? Like, why should the average investor care if the fund is lending out shares?
Because securities lending generates extra, virtually risk-free revenue for the fund.
Oh, interesting.
Modern open-end ETFs do this routinely. They lend shares to institutions, collect interest on the loan, and then use that revenue to offset their own management fees.
So it effectively boosts the return for the retail investor.
Exactly. But QQQ legally cannot do that.
So that is just pure lost income left on the table.
Yeah.
But the second limitation of the UIT structure is the one that really blows my mind.
Yes, the dividend problem.
Yeah, talk about this.
A unit investment trust cannot legally reinvest incoming dividends from its underlying holdings between its scheduled distribution dates.
Wait, stop there. Break that down for us. If I own QQQ, and Microsoft, which is a massive holding in that fund, pays out $1 billion in dividends in the first week of the quarter, what happens to QQQ's share of that money?
It goes into a non-interest-bearing cash account, and it just sits there.
It sits in cash, earning 0%.
Earning zero. It has to sit completely idle for weeks or even months until QQQ's scheduled quarterly payout date, at which point it is distributed to shareholders.
That is insane. In a rapidly rising tech market, having millions of dollars sitting in a dead cash account instead of being actively invested in the market, I mean, that creates a constant mathematical drag on your returns.
It is quite literally called cash drag in the industry. It's a structural handicap that degrades performance in every single distribution cycle.
Just weighing it down?
Yeah, and over a decade, that missed compounding on those dividends adds up significantly.
Which brings us to the fixer, the QQQM savior.
Right. In October 2020, Invesco, which is the exact same asset management company that runs QQQ, launched QQQM.
And it's identical.
It tracks the exact same NASDAQ 100 index. It holds the same 100 non-financial tech giants. But crucially, it was launched as a modern open-end fund.
Meaning Invesco finally took the handbrake off.
Precisely. Because it is an open-end fund, QQQM can lend securities for extra revenue.
Yeah.
And more importantly, it can reinvest those incoming dividends from Microsoft or Apple immediately, completely eliminating that legacy cash drag.
So your money is always working.
Always. And to sweeten the deal, Invesco launched it with a lower management fee. QQQM charges 0.15%, while the legacy QQQ charges 0.20%.
So again, just like SPY and SPYM, we have a situation where QQQM is the strictly mathematically superior choice for the retail investor who wants to buy and hold.
It absolutely is.
Meanwhile, QQQ, with its massive daily volume and a highly liquid options market, remains the optimal tool for active day traders and institutions.
Correct. Over a 10-year period, that 0.05% fee difference on QQQM, combined with the total elimination of the cash drag, well, that translates to real tangible wealth in your pocket.
And the share price dynamic mirrors State Street as well, right?
It does. QQQ currently trades up in the $500 to $600 range, while QQQM was designed to be much more accessible, trading down in the $200 range.
So if you are a long-term investor building wealth slowly, you want the modern structure. It's that simple.
It really is.
Okay, so we've established the mechanics of the broad market with SPY and the tech-heavy NASDAQ 100 with QQQ. But what if you are a listener who doesn't want the broad market?
Right. Some people want focus.
What if you don't want utility companies or banks dragging down your returns? What if you want pure growth?
The high flyers.
Yeah, you want the innovators, the disruptors, the companies changing the world. Most investors in that mindset turn to the low-cost titans of the industry, like Schwab's SCHG or Vanguard's VUG.
Very popular funds.
Very popular. But here's where it gets really interesting. There is a massive, dangerous illusion hiding in plain sight within the fact sheets of these pure growth funds.
It is the illusion of diversification. And it is arguably one of the most dangerous blind spots for retail investors navigating the 2026 market.
Let's dissect the pitch versus the reality for a fund like SCHG, because the pitch is brilliant.
It sounds great on paper.
It does. It markets itself as a diversified large-cap growth fund tracking the Dow Jones U.S. Large Cap Growth Index. You look at the summary, and it says it holds 196 different stocks for a tiny, razor-thin fee of just 0.04%.
So cheap.
For the average investor, that sounds incredibly safe. 196 companies. If 5 of them go bankrupt, who cares? I have 191 left, right?
It sounds deeply comforting until you look at how those companies are actually weighted, because these are market cap weighted indexes.
Break down how market cap weighting actually works mechanically, because I think a lot of people just assume a 200 stock index means you have roughly 0.5% of your money in each stock.
Not at all. In a market cap weighted index, the size of a company's total market value determines its slice of the pie within the ETF.
Okay, so bigger company means bigger slice.
Exactly. If company A is worth $1 trillion and company B is worth $10 billion, the index is forced to buy drastically more of company A.
Right.
It is fundamentally a momentum trade embedded directly into the index's rules. As a stock goes up in price, it becomes a larger percentage of the overall market, so the ETF is forced by its own rules to buy more of it at the higher price.
It's a snowball rolling downhill. It just gets bigger and bigger purely because it's already big.
Exactly. And because of the massive run-up in mega-cap tech over the last few years, the concentration at the very top of these funds has become extreme.
How extreme?
In SCHG, despite holding 196 stocks, the top 10 holdings drive a staggering 59% of the entire fund.
Just let that sink in for a moment. Out of 196 companies, just 10 of them control nearly 60% of your money.
It's incredibly top-heavy.
NVIDIA alone sits at 11.82% of the fund. Then you have Apple at 10.40%, Microsoft at 6.03%, followed by Amazon and Alphabet.
This is what we call concentration risk masquerading as diversification. You buy SCHG thinking you're buying a broad, robust basket of American innovation across multiple sectors.
Yeah, that's what the label implies.
But the reality is that SCHG's top 3 holdings, just 3 companies out of 96.9, account for more total weight in the fund than the entire healthcare, industrials, and financial sectors combined.
That is terrifying. And Vanguard's competitor, VUG, is no better.
No, it has the exact same issue.
VUG tracks a slightly different index, the CRSP U.S. Large Cap Growth Index. It's an absolute giant of a fund, boasting $353 billion in assets, also charging just 0.04%. It holds 160 stocks.
Again, look past the 160 number and look at the reality of the weightings.
Right. The top 10 positions make up 61.4% of the portfolio. NVIDIA's is 12%, Microsoft is 10.7%, Apple is...
So when you buy SCHG or VUG in 2026, you are not buying a diversified growth portfolio. You are essentially making a highly concentrated, levered bet on the mega-cap tech sector And more specifically, you're making a localized bet on artificial intelligence infrastructure.
Because what are those top companies? NVIDIA, Microsoft, Amazon, Alphabet.
They're all AI plays.
They are all fundamentally tied to the exact same AI capital expenditure narrative. They are building the data centers, they are designing the silicon chips, they are writing the massive large language models, and they are providing the cloud computing power to run them.
And that creates a terrifying correlation problem.
Explain correlation here.
The whole point of diversification is that if one sector suffers, another sector thrives and balances your portfolio.
Like if tech falls, maybe healthcare goes up.
Right. But when the AI narrative wobbles, and it frequently does, when Wall Street starts demanding immediate returns on those hundreds of billions of dollars in AI investments, these stocks do not move independently of one another.
They wobble together.
They wobble together. The diversification you thought you had in your 196 stock fund instantly vanishes because the underlying macroeconomic thesis driving your top 10 stocks is identical.
I want to walk through the real-world math on this because this is where the 196 stock costume really falls apart for the average investor.
Let's do it.
Let's say you invest $100,000 of your hard-earned money into SCHG. You feel great. You're diversified. Now, let's assume those top 10 tower names hit a rough patch. Say they suffer a 25% drawdown.
Which, by the way, in the tech sector is incredibly common. We see 25% corrections in mega-cap tech routinely during normal market cycles.
Right. It's not even a black swan event. It's just a bad quarter. So a 25% drop on those top 10 names means your $100,000 investment just suffered roughly $14,300 in paper losses instantly.
Just from 10 stocks.
Just from 10 stocks. Now, the natural instinct is to look at the rest of the fund. You think, well, I have 186 other companies in here. Surely they will buoy the fund.
But they physically cannot.
No, they can't. Because collectively, all 186 of those remaining companies account for less than half the weight of the portfolio.
It's mathematically impossible for them to save you.
Even if every single one of those 186 smaller companies has a fantastic green, profitable quarter, they are mathematically irrelevant against the gravitational pull of a mega-cap tech sell-off.
You are holding an index fund wrapper, but you are carrying terminal single-stock risk.
Wow.
An earnings miss from NVIDIA or a sudden aggressive antitrust move by regulators against Alphabet will hit your quote-unquote diversified SCHG or VUG portfolio much harder than you would ever expect from reading a marketing sheet.
We always praise low fees, and a 104% expense ratio is fantastic for long-term compounding, but that low fee offers absolutely zero structural protection against this extreme concentration risk.
Zero protection.
Okay, hold on. Let me push back here, because when I'm looking at my brokerage account right now, I'm thinking, why should I care about concentration if it's making me filthy rich?
That's the common defense, yeah.
I mean, if we look at the actual performance of these funds, they have absolutely dominated the market over the last decade.
Oh, without a doubt.
Look at the numbers. SCHG generated a 10-year rolling return of 453.41%. That is an 18.66% annualized return. VUG posted 416.45% over 10 years. And if we look at a 5-year window, QQQM compounded at 15.54% annually, slightly beating SDHD's 14.13% and crushing SPY's 13.29%.
The returns have been spectacular.
So if the returns are this astronomically high, isn't the concentration a feature, not a bug? Why shouldn't I just ride the AI wave until it crashes?
Well, it's a feature on the way up, yes.
Yeah.
But it is a catastrophic, wealth-destroying bug on the way down.
Yeah, okay.
And we have very recent data to prove exactly how painful that bug can be.
Yeah.
We just have to look back at the 2022 bloodbath. This is the ultimate drawdown reality check.
Walk us through what mechanically happened in 2022.
Okay, so in 2022, global inflation spiked and the Federal Reserve was forced to rapidly and aggressively raise interest rates.
Right.
Now, we have to understand how a growth stock is actually valued. A company like Amazon or NVIDIA is valued based on the cash flows it is expected to generate many, many years into the future.
Right. You aren't paying for what they make today. You're paying for what they will theoretically make in 2030.
Exactly. And the financial formula used to determine what those future earnings are worth today is called discounted cash flow.
Right.
When interest rates are at zero, money is essentially free, and future earnings are deemed highly valuable. But when interest rates rise to 4% or 5%, suddenly you can get a guaranteed risk-free return just by buying a treasury bond.
So the math changes.
The math violently changes. The discount rate applied to those future earnings skyrockets, meaning the present value of those growth companies plummets. They're violently repriced downward.
And in that environment, the concentration that you thought was a feature became a living nightmare.
Exactly.
Let's look at the actual losses. During the worst of the 2022 drawdown, SPY, the broad 500 stock market, fell 24.5%. That hurts.
It does.
But look at the concentrated growth funds. SCHG fell 34.59%. QQQM fell 35.05%.
Brutal.
You lost over a third of your total wealth simply because your portfolio was overwhelmingly concentrated in the exact sector that was mathematically most vulnerable to a macroeconomic shift in interest rates.
It is the pure cost of volatility. You are absorbing massive downside risk. And this brings up a really fascinating counterintuitive point about risk mechanics and a metric called beta.
Beta is basically a measure of a fund's volatility compared to the overall market, right? Like if the S&P 500 is assigned a beta of exactly 1.0, a beta of 1.2, I mean the fund is 20% more volatile, it swings 20% harder in both directions.
Correct. Now let's compare two of the funds we've discussed. SCHG holds 196 stocks. QQQM holds just over 100 stocks.
Right.
Logically, you would assume the broader fund, SCHG, is more diversified and therefore less volatile. But the data shows the exact opposite. SCHG actually has a slightly higher beta 1.21 compared to QQQM's 1.18.
Wait, how is that mathematically possible? How does a fund with almost twice as many companies swing harder?
Because of the specific index rules. SCHG tracks the Dow Jones U.S. Large Cap Growth Index, which reaches significantly further down the market capitalization spectrum than the NASDAQ 100 does.
So it's grabbing smaller companies.
Exactly. In order to get to 196 stocks, SCHG has to include dozens of smaller cap growth names.
And those smaller companies are inherently more volatile.
Highly volatile.
Yeah.
They don't have the fortress balance sheets of an Apple or a Microsoft.
Right.
So look at the toxic cocktail you are drinking. You are taking on the massive, top-heavy concentration risk of the top 10 megacaps driving 60% of the fund.
Right.
And D, for the remaining 40%, you are injecting the amplified, erratic volatility of smaller growth companies at the bottom of the index.
Oh, wow. So it's a double whammy.
It is. The supposed safety benefit of having a wider 196 stock index is completely offset by the volatile profile of those exact additional holdings.
So what does this all mean for us right now? Because past performance, that massive 10-year run, is entirely backward-looking. We need to look at exactly where the macroeconomic landscape stands today in 2026 to understand why blindly buying these cap-weighted growth funds might be incredibly dangerous moving forward.
This is where we have to bring in the forecasts. The landscape in 2026 is shifting dramatically under our feet.
It really is. I was reading through the expert forecasts for Morningstar, specifically the insights from Christine Benz, their director of personal finance, and Dave Sequeira, the chief U.S. market strategist.
Bank analysts.
And the narrative has totally flipped from a few years ago. Recently, the quote-unquote big six banks, JP Morgan, Bank of America, et cetera, have actually been outperforming the magnificent seven tech stocks.
Which is a stark, almost jarring reversal from the previous 3 years where tech was the only game in town.
Right.
And the mechanics behind this rotation are highly logical if you watch the barn market. We are seeing what is known as a steepening yield curve.
Okay, let's translate steepening yield curve into plain English. We hear this on financial news constantly, but why does a bank actually care if a curve is steep?
Think about how a bank fundamentally makes its money. It's a very simple spread business. They borrow money at short-term interest rates, literally by paying you interest on your savings account.
Right.
And they lend that money out at long-term interest rates, like a 30-year mortgage or a 5-year corporate loan.
So the difference between those two rates is their profit.
Exactly. It's called their net interest margin.
Got it.
Recently, yields on short-term U.S. Treasury securities have been falling as the Federal Reserve cuts rates, meaning the bank's cost to borrow is getting cheaper.
Cheaper for the bank.
But longer-dated bonds remain elevated due to lingering inflation fears and massive government deficit concerns. So long-term rates stay high.
So the gap widens?
Yes. This steepening curve, lower short-term rates and high long-term rates, is highly profitable for banks. It drives their net interest margins through the roof.
Oh, I see.
Combine that massive cash flow with a boom in mergers, acquisitions, and investment banking activity under a more deregulated environment, and you have a perfect recipe for value stocks to vastly outperform growth stocks.
We are witnessing the great rotation. Capital is moving. There is growing skepticism in 2026 around the AI-related stocks.
Absolutely.
Like, have they run too far too fast? Are those massive multi-billion-dollar capital expenditures on data centers actually going to generate the expected software profits?
People are starting to ask the hard questions.
Yeah, that skepticism has driven a massive institutional rotation toward value stocks in international markets. You look at firms like BlackRock and Vanguard, the biggest asset managers on the planet, and they are almost universally expecting non-US stocks to outperform US stocks over the next several years because international markets are cheaper.
But what's fascinating here is Dave Secura's counterintuitive point about what this rotation has actually caused.
Oh.
Because of this recent 2026 tech sell-off, where investors fled the NASDAQ to seek safety and value in international, the growth stocks, which had suddenly become the out crowd, have actually become increasingly undervalued again relative to their long-term potential.
So the pendulum swung too far in the other direction.
Exactly. The growth companies didn't stop growing, their stock prices just took a hit. So they are suddenly trading at very attractive valuations again.
Which creates a massive, frustrating dilemma for you, the listener. You hear this and think, great, growth is suddenly attractive again, it's on sale, I want to buy the dip.
Right.
Time to buy.
But the traditional low-cost vehicles for capturing that growth, SCHG, VUG, QQQM, are structurally tied to the exact same cap-weighted methodology that forces you to take on terminal single-stock risk and a handful of mega caps.
You are trapped by the rules of the index.
Exactly.
If you buy VUG today to capitalize on undervalued growth, you cannot just buy the undervalued companies. You are still mathematically forced to put 61% of your money into just 10 mega caps, simply because they are large.
If those specific 10 companies miss their next earnings report, you lose money, regardless of how well the rest of the 150 growth companies perform.
So the million-dollar question is, how can an investor capture this newly attractive growth without taking on that terminal concentration risk? How do we break the cap-weighted trap?
We need a structural alternative.
Right, and this dilemma brings us to a really fascinating structural alternative designed explicitly to solve this exact problem. Enter GARP.
Ah, the GARP ETF. Specifically the iShares MSCI USA Quality GARP ETF. The ticker symbol is simply GARP-R.
Okay, let's break down what GARP actually means, because it isn't just a catchy name. It stands for growth at a reasonable price.
Growth at a reasonable price.
Right, and it charges a slightly higher 0.15% fee. It holds 148 constituents, and it is a completely fundamentally different animal than SCHG or VUG.
Totally different.
Think of traditional cap-weighted ETFs, as we said, like a snowball rolling downhill. It just keeps getting bigger and heavier based purely on momentum. The bigger a stock gets, the more the fund is forced to buy it blindly, regardless of whether its earnings justify the price.
It is entirely price agnostic.
Right, but the GARP index is more like a master gardener. The gardener ruthlessly prunes the overgrown branches, it cuts away the dead wood, and it ensures the entire plant thrives, rather than just letting one giant overgrown branch snap the trunk of the tree.
I like that. It is a phenomenal structural evolution in indexing.
Yeah.
But we have to clarify. GARP is a rules-based index. There is no human portfolio manager in an expensive suit sitting in a mahogany office making emotional guesses about what stocks to pick.
No active manager fees.
Right. It tracks the MSCI USA Quality JARP Select Index, and it operates on cold, hard math. It follows a rigorous four-step self-healing methodology.
Okay, so wait. If this isn't some guy in a room picking these stocks, how does a supposedly dumb index know what to cut and what to keep? Unpack this four-step shield for us.
Okay, step one is the growth score. The index doesn't look at price momentum first. It looks at fundamentals.
Okay.
It starts with the broad MSCI USA Parent Index, which is essentially the universe of large and mid-cap U.S. companies. It analyzes 5 fundamental inputs for every company.
Which are?
Long and short-term forward earnings per share growth, internal growth rate, and historical EPS and sales trends.
So it's looking at actual business performance. Like, are you selling more products? Are your profits growing?
Oh, exactly. It converts these inputs into a composite growth score, and then it ruthlessly cuts the universe in half.
Just chops in half.
Yep. Only the top 50% of companies based on actual fundamental growth make it to the next round. This ensures you are starting with pure, legitimate business expansion, not just value traps or hype.
Okay, so that's the G in GARP. You found the growth, but how do we know we aren't overpaying for it?
That is step 2. The quality and value tilt. This is where it gets highly sophisticated. Among those surviving growth candidates, the index applies a tilt score.
A tilt score.
Right. It looks for high quality, which means companies with a high return on equity, low debt-to-equity ratios, and highly stable, predictable earnings.
You want companies that are efficient with their capital and aren't drowning in debt.
Precisely. And then it looks for value. It
Yeah.
wants cheap forward price to earnings, or PE, and price to book ratios.
Okay.
It takes all that data and weights the selected stocks based on this composite tilt score.
Yeah.
The result, you aren't just buying growth indiscriminately. You are systematically buying high-quality growth at a mathematical discount.
So you're forcing the portfolio to care about fundamentals, not just momentum.
Yes.
But here's the catch: markets change. What happens when a stock you bought at a discount suddenly surges and becomes way too expensive? Or a great company suddenly takes on massive debt and its earnings fall apart? How does a rules-based index adapt to that?
That brings us to step 3, the quarterly refresh.
Okay, how does that work?
Most broad market indexes update very rarely and have incredibly low turnover. SPY, for example, has an annual turnover of less than 2%.
Which means it almost never sells anything.
Exactly. The GRP index, however, rebalances every February, May, August, and November. Its annual turnover is massive, roughly 73%.
73% turnover. If I'm a traditional index investor, hearing 73% turnover sounds terrifying. It sounds like hyperactive day trading.
It does sound high, but you have to understand the purpose. It is the mechanism of self-healing.
Self-healing, okay.
Because factor scores like PE ratios and debt levels change rapidly quarter to quarter, the index automatically drops companies that are broken.
Automatically.
Right. If a company's growth stalls or its debt explodes, the math identifies the failure and kicks it out of the index. And crucially, it automatically trims the overpriced winners.
Trims the winners.
Yeah. If a stock surges 50% in a month and becomes wildly overvalued, its value score plummets. So the next quarter, the index trims the position, takes those profits, and reallocates that capital to cheaper, higher quality growth candidates.
That's amazing.
You don't have to wait for a portfolio manager to read an earnings report and decide to sell. The math executes it for you automatically.
Which brings us to step 4, the ultimate shield. This is the direct antidote to the 196 stock costume we talked about earlier. This is how you prevent 10 companies from running the whole show.
Yes, the structural constraints. The JAR methodology explicitly enforces a strict 5% maximum issuer cap.
Okay, explain that.
No single company, no matter how big its market cap grows, can ever exceed 5% of the portfolio at the time of the quarterly rebalancing.
So NVIDIA surges and hits 7% of the fund.
At the end of the quarter, the index algorithmically cuts it back down to 5%.
And it also has sector constraints, right?
Yes, it constrains sector weights to within plus or minus 5% of the broader selected universe.
So think about what this actually means in practice. Under these rules, NVIDIA will never become 12% of this fund. Apple will never be 10%.
Never.
By enforcing these mathematical ceilings, you actually achieve the diversification you are paying for while still exclusively holding high-quality growth companies.
If we connect this to the bigger picture, it fundamentally changes your risk profile. You are completely protected from a single mega cap dragging down your entire portfolio if they have a bad earnings call.
But the obvious pushback here is, does this rigorous pruning actually generate returns, or does cutting your winners at 5% just stunt the fund's growth and leave you lagging behind the S&P?
It's a fair question, but the numbers answer that emphatically.
Okay, let's hear them.
If we evaluate JART's live performance since its launch in June 2020 through mid-2026, it has delivered a cumulative return of roughly plus 237%.
Wow.
That crushes SPY's plus 166% over the exact same window. It boasts a 5-year annualized compound growth rate, or KJAR, of 15.22%, beating the broad market. So the strategy absolutely works in the real world. It delivers robust growth.
But we have to be completely transparent about the caveats, right? We cannot sit here and anoint the perfect, flawless fund without looking at its blind spots.
No, we absolutely cannot. There are several risks you must understand before buying GAR. First, the ETF lacks a deep historical track record.
Right, you said it launched in 2020.
It launched in 2020. It doesn't have 10-year, 15-year, or 20-year live data. We only have data covering one full bear and recovery cycle. We don't know exactly how the live ETF will behave mechanically in, say, a prolonged multi-year stagflation environment like the 1970s.
That is a very fair point. Backtesting is one thing, live trading is another. And we also have to note its recent softness, too.
Yeah, the short term.
Looking at the latest data we pulled for 2026, Jorup had a 3-month return of negative 5.81%, which cooled significantly from its peak back in January. The momentum has definitely slowed in the short term.
It has. Furthermore, when you buy JARP, you are making a very specific structural trade-off.
Which is?
You are trading away global diversification, like you would find in a global fund, in exchange for highly concentrated U.S.-only factor exposure.
Right.
And because the index rules explicitly exclude the bottom 50% of the market to focus purely on growth, JARP does come with slightly higher volatility than the broad S&P 500.
So it's not a sleepy, low volatility fund.
No, it is a sharper tool designed to cut through the market cap noise, which means it requires a firmer, more disciplined hand from the investor.
So what does this all mean? I mean, we have covered a massive amount of ground today.
We really have.
We watched the evolution of the market from the incredible birth of SPY in 1993 that gave us intraday trading to the critical structural fixes of QQQM that saved investors from the legacy cash drag of UITs.
The ETF space has just evolved so much.
It has, and we exposed the absolute illusion of safety hiding in the cap-weighted structures of SCHG and VUG, where you think you're buying a diversified basket of 200 companies, but you're really just making a massively leveraged bet on AI infrastructure.
That 196 stock costume.
Yeah. And we explored how the GURARP ETF uses cold mathematical rules-based methodology, specifically that vital 5% issuer cap and the 73% quarterly turnover to enforce discipline and self-healing in a market that has become dangerously top-heavy.
Ultimately, it is about knowing exactly what you own. You have to ensure that the internal mathematical mechanics of your fund actually match your personal investment philosophy.
It has to match what you actually want.
Right. If you want pure momentum, if you want to ride the wave of whatever is biggest right now, cap weighting gives you that momentum.
Sure.
But if you want disciplined, self-healing, fundamentally sound exposure to growth that limits your downside risk, you have to look for structural constraints like GARP.
And this raises an incredibly important question for you to mull over as we wrap up this deep dive.
There's that.
We've talked endlessly about the current megacaps, the NVIDIA, the Microsoft, the AI infrastructure plays. But what if the very definition of what constitutes growth fundamentally changes over the next decade?
Think about it deeply. Right now, in 2026, artificial intelligence is still seen as a high-growth novelty. It commands massive capital expenditures and astronomical stock valuations.
Right.
But what happens to those companies when AI inevitably transitions into a standard, heavily regulated utility?
Like electricity.
Much like the electricity grid or basic internet infrastructure or enterprise cybersecurity, it becomes absolutely essential to human life, yes, but the explosive double-digit profit growth phase ends.
If that transition happens, the static cap-weighted funds of today, the SCHGs and VUGs that are mathematically forced to hold whatever is biggest right now, they will be trapped holding yesterday's growth.
They'll be stuck.
They will be holding massive 60% concentrated bags of low-margin, utility-like tech giants, while dynamic self-healing indexes like GARP, which are constantly pruning and aggressively reevaluating fundamentals every single quarter, well, they will quietly drop those stagnating tech giants and automatically rotate your capital into the unknown, undiscovered growth engines of tomorrow.
It is the profound difference between buying a static snapshot of the past and investing in a living, breathing ecosystem.
Thank you so much for joining us on this deep dive. We hope this entire breakdown empowers you to crack open those fact sheets, look past the slick marketing, understand the actual mathematical engines driving your wealth, and never assume that a 200 stock list means you're diversified. Keep questioning, keep learning, and we will catch you on the next deep dive.